So essentially, this session is a session around how to assess what sort of finance leader your business needs, and what are some of the key parameters that a portfolio CFO or a first-time finance leader in a startup should be assessing and establishing. So I'll let Ciaran do a quick intro, if that's okay, and then we'll dig into it.
That's good. Thanks, Andrew. Yeah, I'm Ciaran. I call myself a virtual FD. I basically work with a portfolio of early stage companies. Some you would say are quintessentially startups. Others are more lifestyle businesses that are just small in scale. And the business I work with, you might hear the word part-time, full-time. I kind of consider myself as a full-time FD for each business. I'm just not working with them more than 2 to 3 days a month. So Andrew will give us more of the growing pains as we go through the session. But basically, I work with businesses that need some FD level expertise. They're just not ready for a full-time finance director. So it's almost like a stepping stone into the world of, I'd like to grow my business. I've had some sales traction. I need to raise investment, all that usual stuff. And without trying to oversell myself, we all know that the space of numbers can get quite complex quite quickly. And my role, I guess, is to help business owners get through that complexity. So primarily they'll come with a skill set that's sales or product or marketing or content or creative or ops or tech background. Numbers really isn't their comfort zone. So they've got everything to gain by getting on top of it. And also the kind of the headaches and the stress drop away and the credibility improves and all that stuff.
Perfect. Thanks, Ciaran. If we've not spoken before, I'm the founder of Zanda, and essentially we support seed through to Series C, D startups with establishing finance functions, and basically partnering with founders on providing what the options are on the scenarios. And we'll go through a bit of a cost benefit analysis of the different options based on the sector and segment you're in. In light of us having two brilliant participants today, actually somebody else has just come into the room, it would be useful, if you don't mind, just doing a quick intro, because this session is sometimes useful for CFOs going into the portfolio space, but it's also probably more tailored also to founders looking or CEOs looking at their business. So if we can just very quickly, in light of there being 3 of you, just let us know what your day job is. We can then tailor the session a little bit around you. Any thoughts on that, Ciaran? Obviously you've got a lot of expertise in all of those areas, but what are some of the fundamentals you see when you go into a business of these types?
Yeah, I tend to, and I was going to say, I suppose for Joe, Michael and Charles, if you want to add any questions during this session, I guess Andrew and myself kind of flex it depending on who joins us. So it really is to try and maximize the value you can get out of this session. If there's any questions that pop into your head, just stick them in the chat bar and we'll keep an eye on it. So we kind of cover everything. But yeah, I mean, I suppose my experience working with early stage companies is that they normally, it's not a sale pitch process into a business, they normally have a problem. And that's lovely. So when someone has a problem, at least you can identify whether that is the only problem they have. So I tend to have a lead question, and I suppose be curious if I know, Charles, you got a slightly different hat on, but maybe if I ask you all a question and you can think of an answer, is what's the number one financial priority that you've got right now today? So what would you say is the top of your list? What's the number one financial priority that you have, or headache that you have right now today? Normally, I'll let you put your answer in, but normally the CEOs or founders that come to me have a problem. Now, it might be that they just need a model. So where are they going? They might need a view of how their business is doing, so actuals. They might need just to get on top of their capital structure. So a forecast that said, how much do we need to raise? And when it comes to valuation, where do you start? And then the 4th pillar is normally the metrics. So what metrics underpin your forecast? And do you have any actuals that can back them up? So every forecast in my head is just a bunch of ifs. So it's kind of a simple case of how good are your ifs. Now, if you've got actuals, forecast, structure, and metrics, you've got 4 things that on their own every business needs, but actually they start to connect with each other quite well. So if you've got actual metrics, have you got forecast metrics? If you, from a forecasting, again, the funding question, cash flow and cash flow runway is super important, but even just connecting how much money you need and cash burn, everyone will say, when do you run out of money? But at the same time, how is sales growing? Because back to your kind of intro, Joe, if your business is growing and you know we're going into an A round opportunity, it might be 6 to 9 months to close the right A round. You will obviously be hoping to have higher revenues in 6 to 9 months time, but when can you start the process? So you end up, so I suppose each conversation comes with probably with a CEO saying something is, I need help right now. And it's not really ideal from a planning point of view to try and we can start a conversation, it's fine, but you can't always fix a problem right now. What you're trying to do is plant seeds as quickly as possible with founders and CEOs that they might not need FD help now, but at least they're aware of what the issues are. So as the growing pain kind of starts to niggle, they do something about it much sooner rather than getting to a position of distress, whether it's cash flow or something else, credibility, or trying to close an investment round. They're not leaving it too late. And I appreciate it's even easier than ever to be using the likes of LinkedIn and networking and producing content that isn't pitchy. It's actually just trying to plant the right seeds in the heads of founders. So I love, Charles, you saying that you came in with 110 heads in the business. I mean, I've got a client that has close to 80 heads, but with the right processes in place, it's absolutely fine. But I've worked with some businesses that have maybe headcount of 10 or 12, and it's, when you come in, it's quite chaotic. So I guess I'm always quite curious as to where the growing pain is, because you got 110 people querying where their P60s are or changing pension contributions or something. If the likes of Joe or someone else in the business is receiving those queries, you can be overwhelmed so quickly. So yeah, so planning ahead is good. Having a problem is great because you can deal with it. And I suppose we'll come on to your queries in a second. Let me open the chat. The key thing is that when you solve one problem, like, so we got Charles saying managing cash flow and burn. Joe's got cash flow as well, better management reporting. The key thing is when you solve one problem, especially in the finance place, you could have a problem next week, next month, tomorrow. I mean, we all know in this space, and I think you build up experience knowing that as you solve one problem, you may never see that problem again, but cash flow will be a recurring, I say problem, it's a recurring issue to stay on top of. It just means that, I suppose, for management reporting or cash flow is just improving and beefing up the system and the process and making it more robust is where you want to end up. So as you report cash flow, just as an example, all the businesses I work with, we have a 60-day rolling cash flow period. So it's almost by day we can see, it's not always going to be spot on, but where our cash moves over 60 days. And because it's a rolling 60 days, if there is an issue on day 60, in 15 days time, it's going to be at day 45, but at least we've got 45 to 60 days to see it coming towards us and do something about it. So sometimes the problem may be a one-off, it may be recurring. And I think the mindset, just to finish, the mindset for CEOs and founders and business leaders, as well as Charles from a finance function point of view, is just to feel that if you are on the finance side, or if you're in the non-finance side, you almost have an FD mindset. So Joe, you don't need to become the accountant, but having an FD mindset is not a bad thing to develop from a personal skill set that you may not have to produce the numbers, but you could look at something and say, is that good enough or is that right? And if you don't have anything to look at, so you're saying better management reporting, if you've got nothing to look at, you can say, why do I have nothing to look at? So whether you've got a CFO that's outside the business or a bookkeeper or you can kind of identify where the gaps are. And then when you have gaps, you can just see what does it look like when the information is available.
You must have seen founders that were in a bit of a flap. And then after they've got accurate and insightful numbers coming through once a week or once a month or daily, how that's not just changed their personality and their situation, but also how they act on it. What are some of the benefits of taking them from no data or inaccurate data to something that's pretty accurate and insightful regularly?
Yeah, I mean, I talk about it often where people can see something on a page, whether it's a CEO or a board or a management team. The answer, normally the management team has enough brain power looking at the page to decide what the right thing to do is. If you don't have anything to look at, it's very difficult to steer a team or conversation or make a decision, because now it's just a case of which personality is controlling the room. So there's an element of, if you picture it, if you have no cash flow line to look at, quite often you'll have a CEO or a founder not sleeping at night because they're just running calculations in their head, or they're running the wrong calculations in their head. They're saying, I've got 40 grand in the bank, so I think we're okay. I was like, well, unless you can see what your bank balance is doing for the next 60 days, how do you know it's okay? It probably isn't okay. So the degree is, the easiest way is, it's a time-saving, stress-saving process by having the right systems in place. So if you think of a board meeting where you have no financial reports to look at, even high level, it could easily soak up 90 minutes, 2 hours of a board meeting. If you had something that's clean and snappy and well presented, I mean, some board minutes, I'm just given 10 minutes to go through. Now, you can have plenty of stuff to share, but you use your 10 minutes for everybody to understand that things are in good shape. We can see what's going on. We're not going to run out of money. We've got credibility in our reporting and our sales numbers and everything else. And if needed, we can drill into the detail, but we don't need to, because we trust it and it's credible and we understand what issues we need to deal with. 10 minutes versus 2 hours. So you're kind of collectively allowing the business more time to focus on sales and product and all the other things it needs to give due attention to.
I think some of the experienced portfolio CFOs and VP of finance and CFOs that we place, part of the education around getting an insightful MI pack 72 hours ahead of a board meeting means that instead of them receiving it that morning or on the day, they are processing information that's been put in front of them straight away, which takes them 60 minutes to get on top of. They're on the back foot, they've not had time to sleep on it, and therefore the conversation is already on the back foot talking about that pack. Whereas 72 hours in advance, where it's graphical, insightful, maybe there's a couple of videos from business leaders within it, it enables the board, whether it's non-execs, chairmen, CEOs, it enables them to already cogitate on the numbers, the analytics, and what they're reading, and thinking about how they could add value and how they could make things better. So, I appreciate some of these businesses may not have non-execs or advisors, but I know from experience CFOs that produce a pack 72 hours in advance, which includes maybe a video from the head of people talking around their pipeline of growth strategy and how that's going to impact on the business, and the MI and the key things to discuss at the meeting. It can put senior leaders in the limelight for a retention perspective. It's great for them to get profile to the board. It enables all of the data and historical information and drives the discussion to 90% strategic forward looking. And people are thinking about their external network and how they can promote your business and how they can add value. There's the old adage that, the board meeting, they will discuss whatever's put in front of them. So if you want 60 minutes to be discussed whether you should get a coffee machine that's worth $3,000 in the office, then you can talk about that for an hour. But really, they're decisions that the execs make. You're running the business. It's not the board running you. It's how you leverage that. But you've got to give them the opportunity to do so. And the CFO role is obviously, massively influential in that. What core basics do you like in a board pack, Ciaran? I appreciate it's sector specific, but what do you like?
Yeah, a lot of the stuff I would say is almost very consistent from one business to the next. So I kind of consider it to be something that's quite layered. So if you picture sending out a PDF, first of all, kind of Joe's flagged, having better management reporting. sometimes you want to just have, I say, a one pager that everyone can look at, visual graphs in a PDF that shows it's kind of make it easy for your board and your non-execs to see and get a frame of reference as to where they're at and what's going on. So simple headlines at the top. I don't really write commentary about a number that you can already see on the page, so let the numbers actually speak for themselves. But you can picture that if you've got a 25-page PDF, that the Excel files or the reports are formatted to be PDF'd in the first place, you might only be going through the top five pages of outputs, and that sets it out. It sets out, you take cash flow and runway and cash burn, it sets out whether it's just something that is going to happen, or it sets out whether there is an issue that needs to be fixed. So more often than not, good financial governance will mean that we've sorted out how we buy stock. We don't overstretch our cash flow. Customers pay us. All these simple things are applied day in, day out. So when you talk about cash burn, you can just, it's an eventuality. We're trying to plan, have we got 4 months? Have we got 8 months? But what we've ruled out immediately is the uncertainty of somebody doing something that gets through too much cash too soon, like buying too much stock or trying to chase a cost reduction by tying up too much of our cash into something too soon. So you can end up, from a reporting point of view, make it easy for your board, make it easy for your non-execs just to see what's going on, and be mindful of the fact that if you have a line or a trend, a graph is going to show it far more easily than giving somebody a line of numbers. So if you want to show uplift, put a graph on it. If you want to show a kink as to something, put it in a graph. Everyone can see a graph a lot more easily and discuss it. And you'll find that actually, if you go into your first board meeting, might be one for Charles as well, and for Joe, you can always ask the question and say, can I have the following? Or where can I get the following? And either your bookkeeper can produce it, or your CFO can produce it, or the likes of Charles can produce it. It's always great to just say, is there anything else? Is there anything missing? So I've got a classic, if I see somebody reaching for a calculator or a spreadsheet, and I'll just have to ask and go back to the sector specific stuff, what are you doing? Like, what number are you calculating? Because that could be something that should just be in the deck. And sometimes, more often than not, the same metrics pop up in every business: revenue per something, revenue per square foot, revenue per customer, revenue per, revenue per transaction. You will always have a split of something. The same metrics come up time and time again. Is if we can have a financial number, we can see what's going on in absolute terms, but actually we need to see underneath it proof points, what's actually underpinning the numbers. So don't just give people numbers, try and give them the metrics and the derived metrics as a result.
Thanks, Ciaran. And Michael's put something in chat. How often do you refer back to your pitch book or pitch deck, I guess, as it relates to the timing of growth and financials?
Yeah, interesting one. I would say more often than not, most pitch decks that I've seen are out of date super quickly. So quite often, if a business is going well, and you probably see this, Andrew, as well, from a rapid growth point of view, when a business is going ahead of plan, they'll be very much encouraged to consider raising again a lot sooner and to scale the business even quicker. So the previous growth forecast financials, anything presented, are out of date very quickly. But the opposite is also very true, is more often than not, a business is not going to be hitting the revenue numbers that it put into that plan. Not that they were misleading anybody, but the plan is always just a bunch of ifs. More often than not, the investment doesn't come in as quickly as the plan wanted. Might miss a season, it might miss the starting point of where it wanted, or some key hires. So more often than not, it's behind the curve anyway. So what tends to happen is if you think back to the finance deck, we tend to be reforecasting. So we'll have 3 lines on a graph. We'll be showing actuals, we'll be showing the original investment plan, and we'll be showing a forecast. So quite often the investment plan is almost reset from a certain date, or the business might have changed its mind. But at least when an investor or a non-exec turns up, we're being quite open and quite transparent, just to show them on the same graph where we're at, where we said we would be, and actually where our latest thinking is. And it does help have a good, frank, open discussion as to whether that is good enough, realistic enough, and if there is a gap to be bridged between, the investment plan or anything else. In fairness, I'm just thinking of the financials mainly within the original investment plan or pitch deck. If there's a discussion to be had, quite often you have a representative sitting at the board meeting, so you've got to give them ample detail as to what's going on, because they're not always the investor, they're just a representative.
It's interesting, isn't it? All of the things that have been talked about: cash burn, improved management reporting, performance reviews. As the business progresses and gets different investors, or is bootstrapped and grows to 100 plus headcount, they're the same challenges, but they're put in greater magnifying glasses on them because the pressure of the situation is getting potentially bigger. But if you've got the right structure and process around it, it can give you comfortability that actually can scale as the business scales, and it might be a couple of extra zeros on the end. And that psychologically is obviously a big difference. You may be dealing with index, not angel investors, which obviously is a significant difference. But from a functional, financial, operational standpoint, the structure can be set up to do the same things, which can give founders and CFOs the comfort that they're ready for what's coming next.
Charles, have you got a question?
Yeah, I was wondering how in an early stage startup you approach cash flow or liquidity monitoring. Obviously there's way less certainty over revenue growth, timing of cash collection. Are you developing a couple of different models of something that's more conservative or stressed and a best case, or I'd be interested in your sort of experiences as to what works well?
Yeah, it's a great question. It's sometimes very difficult to model what's going to happen in the real world. So I'll give you an example, is that you may have a SaaS type business where you will most likely close 12-month deals, so 12-month license to use your tech. When it comes to planning, you may obviously would like to, from a cash flow point of view, is build 12 months in advance. And I work with businesses where that's just the default. People pay us within 15 days to 30 days, and our cash flow our balance sheet is clean. We'll still need funding, but our balance sheet is clean. The billing and the payment is not really a negotiation. And the price point, just say it was £1,000 a month, the annual license fee isn't going to annoy a large corporate procurement team that basically says that's not acceptable. So 12 grand a year is definitely easier. If it was a 12 grand a month deal and you're billing 150K, you can see you might start getting a bit of pushback on to say, well, quarterly billing, monthly billing. So I have a client that does around, say, 5 mil a year, and we bill annually in advance, maybe say 8 clients. So average billing is around 800 grand. Bill in advance, paid in advance, very clean model. Self-finances all the funding. I've got other clients then that it's always up for negotiation. And it's a frustrating bit. You try and influence it with your finance hat on, you try and influence. I'm not the sales commercial person closing the deals, but if it's a bit more open season, like sometimes you might be able to bill annually, sometimes quarterly, mostly monthly. It means that when it comes to forecasting your cash flow, you're kind of thinking, well, what are the new customers going to go on to? So what you tend to do is you tend to just pick an assumption that's somewhere in the middle, say quarterly, and it will show in our cash flows every third month, there's a nice big spike of cash coming in, and every 2 months in between, we actually have a cash burn. But when we present it to our board and say, look, here's our funding need, for the moment, we think quarterly from a forecasting point of view is just the fairest way to show this. If everyone comes in annually, we will need a lot less money. If everyone comes in monthly, we'll need a lot more. And I guess the board at least can just see the assumption we're making. And also they can just look at the commercial team and say, right, how realistic can we just deliver on the quarterly? So at least you've got a midpoint that you can track, but the real world sometimes is very different to trying to find a nice, clean, simple assumption to drive your forecast. The alternative I was going to say, I have another client where we do bill monthly on credit. I think Nina might need to. Yeah. We bill on credit and customers pay it. It's quite often for early stage companies where it's quite easy to raise the bill, but the customer then can start pushing back and saying, I haven't got the service yet. And especially if you're a tech business, there's almost like the payment of the invoice is the proof of everything. So you got the finance person with a growing list of accounts receivable that's getting a bit messy, and you think from a cash flow point of view, everything's going to come in, and then suddenly you start getting updates to say, well, there's going to be 3-month credit for them, they're not paying, so we're going to pull the service. You end up with you're at the end point with your finance hat on, and you're last in the line. All the issues that need to be tidied up ahead of you can kind of make it a bit difficult. So it's amazing to go back with investors with a clean balance sheet and say, you don't really score any points for it, but you can confidently say, we bill customers and they pay us, is very different to an accounts receivable list as look at all these invoices, we've got revenues in the P&L, but it doesn't look like customers are paying us. What's going on? So the FD role, really, whether you're a controller or an FD or CFO, whatever, you do have to have that kind of bridge into the rest of your business. And it's great because you're now collaborating with your senior team to make sure that we don't build people when we shouldn't build them. We don't just kind of make our revenue and our P&L look great one month, but the next month it's going to look, poor when we have to put through credits. But at the same time, the CEO understands that your balance sheet is, I don't use the word financial marketing, but it's a great marketing tool to be able to tell your board, run your business, and any prospect investors that you've got customers that pay for it, as opposed to the sense of over trading when you've got loads of customers, you've got great revenues, they're not paying, cash flow is slow, and it's now starting to cause the accounting team and the finance team a few headaches. Does that answer your question?
It does, yeah.
Okay,
Yeah,
cool.
thank you.
Thanks, Ciaran. I'm just going to share my screen now and go through a quick, checklist of the different options to consider when looking at finance hiring. So obviously Ciaran will give his insights on the different parameters. Feel free to put any questions in the chat box if you've got them. There will be time to go through that towards the end. I'll try and kind of whistle through this and then you can ask those questions related to the presentation. So I'm assuming everyone can see this okay? Yeah. So most of the clients we work with, either from partnering with the VC or the investor or the founder, we basically ascertain and provide an option list of what their finance leader could be and why. And these are the parameters on the startup review that we think are essential. So industry sector and the complexity, the realistic growth trajectory, the next milestones and the backgrounds of the senior leadership team. So if we dig into industry sector, I think this is essentially talking about the complexities of the industry sector you're in. If you've got R&D tax credits, if you've got high volume, low value, if you've got low volume, high value, clearly if it's high volume, low value, it's going to be more transactional. So from a finance ops perspective and from an outsourced provider perspective, there's going to be more invoices naturally. If you don't have a resource, that's probably one of the easy outsourcing processes to do as a founder because it's low level of technical ability, but quite annoying, consistent problems. Whereas if it's right up to kind of more of a R&D focused biotech, then clearly the transactional finance elements are going to be very minimal, but it's more of the complex R&D, kind of R&D tax credits piece. You've also got the maturity of the sector and how quickly you need to move to get first mover advantage or to compete against peers. That if you think about the Amazon FP&A space at the moment, which is a massive buy and build of Amazon brands, of solo entrepreneurs, that is an M&A play. It's a newly formed sector to a certain degree, and therefore the speed of pace of it and it being new to the market means they don't need a different type of finance leader than a SaaS firm, which is maybe sometimes more steady, consistent growth. You've got a ton of different industry sectors in your world, Ciaran. What do you see in the industry sector space?
Well, I guess so much of it is consistent and is just neutral. I mean, from a portfolio point of view, I mean, I'm working with some businesses that I would say are, as when they grow much bigger, will definitely look for a finance leader from within the sector. So I've got an insurtech client that, right here, right now, as a startup, from a planning, cash flow, reporting, board relationships, it's done an A round, pensions, payroll, all the stuff that kind of underpins business, we got it covered. But the business wants to go from 100 mil valuation to, winning the Super Bowl. The CFO appointment will come from within the sector for a number of different reasons. One is just their understanding of it, not just the tech, but the commercial opportunities, relationships, everything that you would expect. That a CFO isn't just somebody who sits behind the desk and crunches numbers, is someone who's actually progressing, an input into the product itself, the market opportunity. But each business should be kind of just understanding that it doesn't necessarily need to recruit the industry sector FD on day one. It just needs to get on top of its numbers and deliver that early stage of the plan. But as it continues to grow, we can start to consider to say, right, if we do find a finance lead, whether it's part-time, full-time, when is the appropriate time to bring in that person, almost sitting on top of that finance infrastructure that's already in place. So it's kind of, I wouldn't say it's 90% standard, 10% sector, but to a degree, most of the stuff being processed through a business, like the day-to-day coal face, I would say easily is 85% of the finance headspace. Sometimes it just feels like it's the 15% time or headspace is really specific to a particular sector, but also a complementary skill set to the CEO and other founders. They don't need another founder, they need a finance lead.
I agree. I think one of the things that we do see in the industry sector, depending on which, the outsourced relationships with bookkeeping firms or accountancy firms or specialist third parties will happen sooner, depending on the certain sectors. So, if it's, as I said, high volume, the outsourcing to a third party provider will happen sooner. If it's a biotech, it might be a specific R&D tax credits firm sooner, before you need to hire someone full time within the business. The next one is realistic growth trajectory, which is obviously one of the favorites we have when we're discussing with founders. Founders are obscenely passionate about their business, and glass half full, the vast majority, and therefore their hyper growth expectations need to obviously be checked, because they are going to be very, very optimistic and excited about the growth trajectory. But if it's not a headcount of 20 going to 100 in a year, or an ARR of 2 million going to 10, 15 million in a year, they wouldn't be potentially considered as hyper growth. If a business is going from 40 to 60, or an ARR from 3 to 5, bringing in a CFO that's expecting a hyper growth rocket ship is going to be disappointed. And therefore it's understanding the investors and the founders' growth expectations, but also the realistic growth expectations, so that the individual that comes in is either part-time moving to full-time as it's required, or has the ability to continually step up with a mentor. You've obviously seen these situations a lot, Ciaran.
I know you don't have it on the slide here, but with growth sometimes comes complexity. So you can have a business that can, back to this kind of 5 mil turnover clients that I work with, it's a very simple business. The billing is simple, the service is simple, the accounting for it is very simple. So my role and input into the business is a bit more strategic and kind of has a focus on growth and exit. But equally, a small business can be very complex, like buying raw materials, making a product, selling a product. So it's got, from a finance point of view, it's got to just be on top of its, stock, cost per unit. When it does P&L reporting, it sounds really boring to maybe everyone on the call, but literally moving costs from your balance sheet into your P&L, so you can see that you're actually making profit margins for what you're selling. So you can actually be quite a small business and have quite a complex setup. So when you think of growth, whether it's rapid or hyper, you really need to be on top of things, because if you're not, as things kind of linked to cash flow, if there's a sense of over trading or where's our cash or where's our profit, the complexity of the business might require just a finance structure or head to be able to set out, this is what we're going to do. So a classic, one business I work with probably does maybe say 10 to 15,000 transactions a month, maybe say 10, 15, 20 pounds per transaction. So the revenue recognition is quite complex. It's global, so there's VAT issues on say 30, 40 different countries every month. It is rapid growth rather than hyper growth, but without having kind of a structured approach to capturing transactions, processing them in a high volume, if it couldn't do it with the volume it has today, if it even talked about going near rapid or hyper growth, very quickly it would just be a fluster shambles, shall we say. Because it's got implications on the P&L, it's got implications on the stats you're trying to present to your investors. You've got to have a credible, clean balance sheet. So, Charles will appreciate, and I'm sure, Michael and Joe from their experience will see, when numbers are presented cleanly, everyone kind of just breathes and sees where we're going, and we can talk about growth. But it's very dangerous to talk about growth without actually knowing how you're doing right now today. It's quite a dangerous thing. You can overstretch a balance sheet super quickly. You can leave a P&L where people think we've sold loads, but why isn't it in the P&L? Or I'll give you just one quick analogy or story. I had a client that was doing 5 mil turnover, so hyper growth, ticks that box. 2 mil profits, so it looks great, let's keep going. But its revenue recognition was it was banking or recognizing 5-year deals in the year it sold. So it was considering it as an IP sale rather than a license fee. So by coming in and restructuring it, you actually take a business that's doing really healthy profits to making a £2 million loss. So you can see in one aspect, they feel they're in hypergrowth mode, but actually even the most simple of P&Ls is misleading for anyone to look at.
Yeah, that must have been an interesting conversation for you.
Yeah, not nice to bear bad news, but but the irony is that when people understand where business is at, that although it's making a loss, as most startups are, when people understand what the loss is and how it's being driven, when it does turn profitable, they understand what is driving the profits of the business.
Yeah, exactly.
When you have the reverse, where you have high revenues, they're incorrect, and you've got profits which are also incorrect, they're not real profits. It looks good, but people don't understand it. And when people don't understand it, whether they're an existing investor or a prospect investor, the conversation or relationship is very difficult. So it was bad in one sense to tell people you're actually making a loss of 1.5 mil. It was actually a good thing because now people understood the value of the business. And without going on too long about it, but a lot of businesses are valued based on recurring revenues in some sectors, and in other sectors based on profitability. By just cleaning one bit up actually gave people a real sense of what was the true valuation of the business. So sometimes you feel like by bringing in, I suppose, a bit of financial structure sooner, it really resteadied the founding team of 3 to actually recognize where they were truly at, but they could still get to where they wanted to. And people were now engaging with them because we could explain the business.
Yeah, thanks, Ciaran. And the next 2 segments of the startup review do go hand in hand to a certain degree. So key milestones, and whether that is your next fundraise, that's your Series A, your late seed, your Series B. Clearly, if it's a buy and build strategy or international growth or a product launch, or then the exit piece, then the relevant finance leader needs to come in relevant to those. So clearly, product launch is generally led by a product or a CTO, but a lot of these other areas would be led by a strategic CFO or a VP of finance, who has either led or shadowed as a number 2 elements of these things moving forwards, and is trying to move into a situation where you have got a plan ahead of schedule, so that going into a Series B, you have enough cash burn that it's not a stressful process, and actually the investors don't feel they can get a bit of a deal because you are closing in on when this needs to close anyway. So having a plan and being ahead of the schedule with the key milestones piece is obviously massively important, and is dependent on what your founding team or your senior leadership team have already. So, if you've got one of the co-founders or one of the founders or a senior leader who's previously been in investment banking and has led on IPOs or, kind of fundraising at Series B, Series C, then clearly leading elements of that fundraise will come naturally to them from an investor relations, presentation, negotiation, influencing. They won't be afraid of a Series A that's 150 million or 5 million, because it's the same process, same structure, and they've got the confidence walking into the room, whatever the however many noughts are on the end. If you don't have that previous investment banking, corporate finance, fundraising experience, then clearly a fractional CFO or some support is required to not just get the business ready for it, but also be that face to the investors. And that can be part-time scaling up or full-time. I think that the technical accounting piece, depending on the complexity of the industry sector and the stage of your growth, if you don't have that and you're looking to add 50 headcount, or you're looking to go into 3 different territories you've not been in before, then clearly some finance resource related to that milestone are going to be particularly important. Any thoughts on that, Ciaran?
Yeah, I think that there's always going to be fringes of all of these things. So, the kind of the part-time portfolio FD can give you a bit of a stepping stone to be able to access accounting brain power or expansion brain power. Like, if I want to do the US, do I sell from the UK? Do I create an LLC? Do I have, open a Pandora's box by doing the wrong thing the wrong way? And also, I think there's, we live in a great space now where no one's doing things for the first time. Someone has already solved the problem. So, for example, you can get away with raising an A round with a part-time CFO. It just depends on the skill set of the founders, the CFO, and maybe some M&A corporate finance firm. You may find that actually the scale of the round is you don't need the M&A corporate finance firm because you've already closed your A round, and it's quite accepted that your funding need that when you raise the A round was to cover a full-time CFO. So again, you can always take counsel from your board or investors or non-exec as to what the right thing to do is. There's always people on the market who provide that niche service for what you need, whether it's CFO hat, whether it's raising money. There are people who raise money, don't want to do anything to do with accounting. They just want to be handed a set of numbers. And even just from a personal point of view, I tend to work with founders who raise the money. So I give them what they need to close the money. You can see that as things progress more, things get more complex. When you go into a B round or a C round, the expectation would be is that the people presenting will most likely have more of an involvement from a full-time CFO figure. So things can flex as you flex. There are resources all across the market, and there's sounding boards, out there in your respective networks. Most likely someone has solved this problem before you get to it. The great thing about this, Andrew, is you're kind of teeing up what the issues are for people to just think about it well before you get to the pain point. And if you think you're getting close to that pain point and you haven't done anything about it, I'm sure people, well, me and Andrew, but other people as well who may have experience of going through this, where you can just pick their brain and say, when should I, think about doing the following, or is it okay to stick the cost of a full-time CFO in my A round plan, and I will go out to market with that person, or do I need to think about having a CFO before I close the A round?
It's so individual, based on lots of parameters. So the founding team is obviously a massive parameter to consider, how they manage it currently, how they can manage it moving forward based on the milestones that are coming up and the growth they're seeing.
And the complexity. I mean, you covered complexity.
Yeah.
Complexity of markets, complexity of service. If you're struggling, it's a real good alarm to do something about it. If you're not struggling, you can easily ask the question and say, this appears to be too easy. Do I actually need to go and get myself a CFO? You might not need a CFO for a long time if between your combined skill sets, you're on top of it. So it really is down to the kind of the founding team members to identify, back to something that Joe said, where are the gaps in your business as to where you don't know or where you're not on top of things. It'll give you a good idea of the things that that exist right now today will most likely be bigger gaps when you kind of progress and grow even further. Those gaps won't get smaller by themselves. So if you can close them now, you may not need a CFO for the foreseeable future, but at least you've got some warning signals, that you can kind of take a pulse every day if you need to, just to understand that if we do deliver the next 12 months of this plan and this business gets more complex, shouldn't we bring in somebody to make sure that we don't go off the rails or something goes wrong at the wrong time just before we close that round?
Yeah, I agree. Apologies to Charles and Nina, because I know this piece you'll know very well, having being a CFO currently. But essentially, this gives you a bit of a snapshot of what the different levels within a finance function could be within a startup. So before and below the controller, there's obviously an outsourced provider, and whether that's an accountancy firm or one of the modern kind of startup outsourced providers that are out there. There's also a finance manager or bookkeeper that could be below that. But as you start considering, I guess, a first finance leader, either below a portfolio CFO or as a full-time resource, then you've got kind of these different parameters. So the financial controller, and in between the financial controller and an FD, there's the head of finance job title, which is small nuances between, and then the finance director, and in between the finance director and the CFO, there's sometimes the VP of finance job title as well. The controller, I've listed off some of the core elements, essentially establishing the right systems, processes around month end, year end. They probably will be an ACA or you had an audit background. So the technical and the financial and monthly reporting elements should be managed. The external relationships with the third party bookkeepers or accountancy providers will be provided. With the individual who's previously maybe been in a startup, they may have seen some elements of fundraising before and may be able to support the portfolio CFO in getting the data room ready or the pitch deck ready or the models ready, or liaising with the CEO on some of those areas. Clearly someone who's analytically, commercially minded on the financial models and interested in the strategy of the business can gradually take on more of that once they've established the right outsourced relationships or a small team below, and know that month end and the board pack can be delivered accurately and precisely and regularly. Then in between that, obviously head of finance to FD, and the FD very much can do all of what's been discussed before, but is probably stronger on the commercials and the models. So could build pretty complex models, determining pricing models, liaise with third party partners on commercial deals. They will be pulling together the data room, the due diligence that's required for a fundraise. They will be overhauling and improving the MI to build insightful kind of MI dashboards. They could deal with more complex technical projects around international expansion, setting up legal entities in different countries, tax structuring. It's likely that most of the finance directors have been a head of finance or a controller or a head of FP&A below an FD or CFO in the past, so have seen a round or a B round or a private equity exit of some sort. So they have got that bandwidth and desire to continue to step up. Logically, that would be potentially a VP of finance role or into a CFO role, and the CFO role, either fractional or full-time, will lead the team below on the delivery of core day-to-day and building a best-in-class, insightful, scalable finance function, but really will act as a co-pilot to the founder on what they need, when they need it, and deliver it. That could be a milestone on M&A strategy. It could be a milestone on IPO readiness or an exit plan, or managing the VC pipeline of potential investors, and presenting and negotiating and pitching for the business, making sure the business is being presented in the best way possible, both on paper and in person, to get the best valuation and the best capital possible. Just that general feeling of comfortability around burn rate being managed, process being led, having a diarised structure around when we go to investors, which investors we go to, how we go to them, and taking the founders really on that journey and them leading on it as much as anything. I'm just going to put this salary benchmark on. This is based on London. Obviously, things evolve regularly, but these are kind of some of the basic parameters. Ciaran, keen to get your brief thoughts on this, and then I'll do a quick case study. And then if anybody's got any questions, then just pop them in the chat and I'll ask away, because we're nearing the end.
That's good. I mean, I do joke, you can get a bad FD for 80 grand. So I guess it's worth bearing in mind that if the kind of the advanced planning is not just where you're at and your headspace is at, your combined skill sets and challenges are, it does give you an idea that if you're going to bring in a full-time or a part-time resource to do something, some of them, I guess when you look at cost, in my head, not just because I'm an FD, is always be thinking of what value they are pushing into your business. So for example, a part-time FD or a full-time FD, whatever price that you put in, if you go through the next investment round, where by having a better forecast and a better model and a better actuals and better confidence, and you breeze through due diligence with no or little or no kind of downside pressure on your valuation, it could in theory pay for itself immediately, so much quicker. So yeah, raising money at, for example, 5 mil with great visibility and having no downward pressure, you can understand that the FD role, yes, it is a additional cost for your business. The return from doing so can have an impact on profit, revenue, customer relationships, better value in your model of what you're trying to do. But actually, when you close an investment round, you could already have paid, or it could already have paid for itself in many different ways. So it's worth kind of just not considering the FD role as being a cost. You don't obviously want to bring it in too soon where it feels like a cost. What you're trying to do is, as Andrew's kind of flagged, is thinking in advance as to when you bring somebody in, you can see the impact, or the cost benefit should be pretty clear. It shouldn't just be one for one. It should be actually a multiple of what it's costing you to bring an FD in, is having a multiple positive impact back on the valuation, or even in the actual financials each month that you see.
Thanks, Ciaran. I'll just show two quick examples of case studies. As I said, every startup is different, but this is an e-commerce business. It was medium to high trajectory. Their next milestone was a 5 to 10 million Series A, followed by a Series B 18 months later. The founders did come from a banking background, so could lead on the Series A. They did lead on the late seed. And therefore, they had kind of two options. They had the FCFD shadowing the founders and able to step up, see what happens in the A round and be more impactful in the B round, or get a hands-on finance manager to support on the A round and on the transactional finance, bookkeeping, financial control elements, and then hire above that individual ready for the B round. So in the end, they went for a head of finance with the ability to step up, and someone who'd been a number 2 to an FD before, and then a SaaS one, because we've got some SaaS people in here. Founders from a tech product background. They did a seed round. They've got to do a Series A in 12 months. It's got traction, but it's steady growth. Therefore, they can either go for an outsourced finance manager provider and continue until they need to do the Series A round and maybe hire someone closer to that, or go for this continual portfolio resource and use it as a project resource. So it might be full-time for a couple of months, or a full-time for a few weeks to get things ready at pinch points. But other than that, it's kind of more of a once a month type of relationship, which is what they did actually. So hopefully that gives you a couple of examples. We have got one. Oh, it's not a question. It's he's got to jump off the session. So that's a really good question. does anybody have any final questions? Otherwise, I appreciate it's lunchtime and everyone's keen to have some lunch. I think it's good, Ciaran.
Thank you. Thank you, Andrew. Thank you, Ciaran.
Pleasure.
No worries. Thank you, everyone. Really nice to meet you all and good to speak.
Thanks for your time.
Thank you so
Thank
much.
you all.
Cheers. Bye-bye.
See ya. Bye.